Welcome to the Campground Catalyst Podcast, the show dedicated to fueling success in outdoor hospitality. Whether you're an outdoor adventurer, a campground owner, or looking to build your legacy in outdoor hospitality, you're right where you need to be. We're here to guide you through the fascinating world of campground management, unique real estate strategies, and the gratifying opportunities created by outdoor hospitality. Our mission is to inspire and equip you with the knowledge and insights you need to build a successful business and create a legacy worth leaving. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted outdoor hospitality experts. Subscribe now, join our active online community, and let's ignite our passions and potential together.
All right, everybody. Welcome back to the Campground Catalyst Podcast. I'm one of your co-hosts, Don Spafford, here with my other co-hosts and friends, Adam Lendy, Justin Hoggett, and who's this other guy? Robert Earl. So thanks, everyone, for coming back with us and being part of this adventure with us. Today, we're going to be talking about saving on your capital gains, or exit strategies for campground owners, part of our Legacy Builders section of this podcast. And so this is, something, one of those topics that most people probably won't even think about. You don't consider until you get to that point of, hey, it's time to retire. We need to sell this property. Now what do we do? So it's a good topic to consider and think about well in advance and plan for it in advance, not just wait in the last minute and try to scramble and put things together. So yeah, let's dive into this. You guys, Adam and Justin and Robert have been around this a little bit longer than I have as far as, in the full-time RV campground space. And you've dealt with a lot of property owners yourselves, speaking with them, people that are looking to during acquisitions and whatnot. So what's kind of some concerns that people tend to have or don't realize that they need to figure out well in advance before that point?
Well, I think the worst case scenario is the person who sells the property and then talks to their CPA at the end of the year and says, oh, hey, guess what? You owe the government this much money. Like if you don't do the proper preparation on it, you're definitely setting yourself up for failure. But, the situation we usually run into in our world is you talk to that person who's selling the campground. We're under contract to buy it, and they just now talked to their CPA. So a little bit ahead of time, but, they're still under the gun now.
Sure. Well, obviously, it's in some cases, like for when we're calling up campgrounds looking for ones that are willing to sell to us, they probably weren't even considering selling before that. So they, I can understand they may not have that stuff prepared because they weren't planning to sell necessarily, right? Just kind of the opportunity came up and like, oh yeah, I guess why not sell? But in the case, I think you should always be ready no matter what, because things happen, people's life situations happen. You get sick or get ill or something else that occurs that you all of a sudden need to sell your property. It's good to have that stuff in order, ahead of time to not to have to scramble it and get it all together and try to find it and track it down and deal with that level of stress when that moment comes, right?
Absolutely.
So yeah, I think the government really wants their piece. They've got their hands out. You got depreciation. We talked a lot about that before, and having to that recapture. So another aspect of making sure you've got enough capital, make sure you're paying your taxes and what's due. Yeah, the 1031 is a big option for most people. Getting selling, moving it into another asset that has to be of equal or greater value in total. There's a lot of different rules. Definitely talk to your professionals there, but that's definitely one avenue to partake in. Sorry, Robert.
No problem. And I think 1031 is a great of a like kind exchange, and that's a loose definition on that. So make sure you check that out. Also, you have to be of two minds when you're operating the campground. Now, I know we've run into some bipolar sellers or campground owners. I don't mean that way. I mean, there's a way in which you operate the campground when you're spending your money, when you're making repairs, when you're doing those types of things. And then you do have to think about the tax implications that are going on as you're making those decisions. A lot of times there's things that are done. And the biggest area that I see is with buildings and equipment of not having maintenance logs, because there are improvements, there are things that you did that added on to that building, that added on to, you put a deck out back behind the store. Well, that changes the value of what it was in the first place, and that could benefit you on capital gains. So if you're not thinking of those things strategically when you're spending the money, it's very, very difficult.
I want to jump in real quick because Justin mentioned the 1031 exchange. The trouble with the 1031 exchange, for those who aren't familiar, and he mentioned, of course, it being the like kind, meaning, same asset class for same asset class. Not necessarily that you have to buy another campground if you're selling a campground, or a single family house if you're selling a single family house. It's usually a real estate asset. I've personally been through 2 failed 1031s, and the trouble and I'll tell you why it causes such an issue, I think, is because the people who plan this were not in the business of actually trading real estate. This was something that was done at the legislative level, and it unfortunately has rolled down to us. We met a guy who called it the 45-day shotgun wedding, and boy, could that not be any more true. Is you got 45 days from when you close on the property to identify, generally up to 3 properties. I think you can do more. Don't quote me on that. But then you have to close on one of them within 180 days. Well, it's like, whose crystal ball is working well enough to know if those properties are going to, underwrite correctly, if they're going to be able to get them closed in that time. In my case, I had two separate times that I didn't close on the properties I identified. So, I ended up paying the tax bill and then having to pay an intermediary for sitting on that money.
Yeah, and a lot of times people line up their sales with the purchase. So if you plan ahead, you can wait for that closing, because once that closing happens, then that's where the clock starts. And so making sure they line up as close as possible. Yeah, and Adam, you said 3. Yes, that's the max, unless you want to increase your count, which then the closing rate has to increase with that. So, out of those 3, you can close 1, 2, or 3, doesn't matter. You start adding 4 or 5 more, then the percentage drastically increases and your odds go way down. So you better be really sure of your options there. So, yeah. And if you back out after 45 days, then you just owe the taxes, right? I mean, but designating within 45, definitely key.
Right. And I say the other side of that coin, I guess, is also, as Adam mentioned, the time frame to get it all done, but also then if, a lot of times people feel pressured to have to find a property, have to put in something. So oftentimes you'll get into not necessarily a good deal, maybe get into a bad deal just to try to not pay taxes. You're avoiding the taxes, and you get into maybe something you would not have otherwise normally bought. So you might actually be in a worse off buying a bad deal than just paying the taxes and moving on. Or, I guess the other option is if you were to buy another campground or invest in the campgrounds like with Beyond Our Holdings, then you can possibly still get the new depreciation to offset that gain anyway, versus just putting it into a bad deal to not pay the taxes.
Yeah, I can raise my hand to that, Don. Been there, done that. Been pressured. It wasn't necessarily a bad deal, but it wasn't a good deal. Not something that I would have typically moved on in the past. So, yeah, you definitely feel the pressure. It's like, well, I don't want to pay those taxes, then I'll just take a deal. And in certain environments, right now it's a little bit better. The competition isn't as bad, but some environments you're just whatever it'll happen. Right, just get under contract, get something, But yeah.
Yeah, and you can keep kicking that can down the road, but eventually, if you ever want to cash out, you're going to be paying the piper anyway for your time in the real estate game. So you're going to have to plan for that accordingly and put yourself in the right position. The trouble I think that hits most people though is they end up hitting that tax burden in 1 year. They get that big payout, and then of course they're paying the taxes on it that year. Which is why what we've actually done oftentimes with the campground sellers we work with is structure ways for them to stretch that out over a number of years, reduce the tax percentage they're going to hit in a given year, and eventually kind of kick that can down the road a little bit further so they can make some money on their money in the time, typically by the way of a seller carry loan.
Yep. Yeah,
if they thought about it. If they thought about it correctly, sorry about that, Don. If they thought about it correctly as they're going through this, they could also structure it from the time of when they're going to be paying less taxes on their other forms of income. Again, what Don brought up of if you're pressured, there's a health reason, if there's something to go on. But a lot of times when we bring these things up, we do a CARES report where we evaluate 28 different categories in 4 key areas for campground owners. We do this free of charge for individuals just to give them an idea, a snapshot, kind of like when you go in and get your oil changed and they give you how the rest of your vehicle is doing. And we ask questions about what types of strategies have you used? Have you thought about this? And it's just surprising the number of campground owners that have not thought of their total overall income and how they're actually going to exit out of this property. And that's something that is very important. They get to the point where they're burned out and now they're having to make decisions out of desperation.
And Robert, please tell people where can they find the CARES report that they can fill out for themselves?
Well, they can go to beyondercamp.com/go beyonder, and it'll have information on that for them to do it. We'll also make sure that we've got it in our social post with this particular one. But it's just a service that we provide because it's the information that we gather. We've been there, done that, got the polo shirt, shall we say, and want to be able to share and give back just like we're doing here in the episodes.
Yep, perfect. Yeah, the only other way to, the other option, I guess, to avoid capital gains and taxes is to die and leave your property to your heirs or somebody else to inherit it, and then they can sell it without paying those capital gains. But for most people, that's probably not the option they prefer. You'd like to see your family enjoy that money while you can, while you're still alive to see it. But that's unfortunately the only other way to get away from your capital gains is to die before you sell it. So if you don't want to go that option, talk to someone like Beyond Your Camp that may be willing to purchase your property, or at least you do the CARES report to at least assess where your campground currently stands now and what could be done to improve it. As kind of like Adam hinted to earlier, is keeping good books. I mean, because your property to you might be worth $100 million in your mind, as just from personal reasons. You've built it from the ground up. It's been your life. But the actual value is, of course, going to be based on the income of the property. And if you're not reporting your income correctly, then that's going to drastically change the actual value of your property. So if you want to get the very most you can out of it, you need to make sure you're maintaining those books well, know exactly what your income is, what your expenses are, and reporting it honestly to the IRS as well with your tax returns. Because, as much as you might say it's packed every single day and making $100 million a year, if your IRS reports don't show that, then unfortunately, it's not going to be worth what you think it is.
Although if you have been keeping bad books, at the time you sell, it won't sell for as much, so your capital gains liability will be much lower. So
that's one way to avoid them. That's a good way to avoid it. Yeah, I'm going to avoid capital gains. I just won't claim income for the last 2-3 years before I go to sell it, or I won't, or I'll jack up the expenses. Yeah, we've seen that as well with people. Oh, suddenly I wasn't paid, and now I am paid. And so was my wife, and so was my brother, and so was my uncle, and you have a staff on there to try to do the expenses, inflate them, but that doesn't help you on the sale price for sure.
Yeah, no doubt. Anybody who caught our one of our prior episodes where we talked about the valuation of a property and how you get there knows that we do this by cap rate. And I always say that plan for your exit. Even if you're planning on it being 20 years out, you don't know when something's going to hit you, a life change, a health scare, whatever the case might be, that's going to, or maybe having to care for somebody else that's going to force you out of your business. And if you're caught with your pants down, you might be caught selling at a ding and dent price. So really the idea is we should be running clean books now, considering that we don't know when we might need to exit, and we might not get to choose that date. All too often, and we've seen this. In fact, we had one just last year, property that came our way where the owner had a serious health condition that was going to shorten his life drastically. Now fortunately they were in a position where they kept their books looking pretty good, but they could have been better. We've had a lot of things where they're hiding extra expenses in there, to try to keep their income tax liability down each year. Unfortunately, the banks are going to look at the, as Don mentioned, of course, the P&Ls, the tax returns, everything else. And if they're speaking a different language, they're going to err for the one that shows the lowest amount of income, which means the lowest value. So, just if you remember, if you're going with that cap rate, and today, for example, we're looking at properties trading at about a 10 cap. If you cheat $10,000, of income from the government by overstating your expenses, that's $100,000 you just reduce the value of your property. Just doing simple math, just 10 over that 10 cap. So just think about what the cost of those short-term gains are. That $10,000 in income tax might have cost you a couple $100, but now you turned it into a six-figure loss on your sale.
Great point.
I'm there now. I get Justin. Could you tell me a little bit more about the seller carry and how that could be the benefit for the seller of extending that period of time? Adam, you've had experience with that as well. So tell me a little bit more about that for the owners, or from the operator standpoint. I'm interested, because that would be an expense I would have to cover.
Yeah, it's a great point. And I was going to kind of bring that up as well. We have a lot of people out there that have a ton of equity in their properties, especially those, like Don said, this is your lifeblood, you've been in it for 25 years, whatever, you're right. And you've got maybe no mortgage due, or maybe just a couple $100,000, and you can request that the buyer bring in that 200,000, pay off the mortgage, or just maybe it's the nice money to live on, to do your trips that you're now planning and as a seller, and then have it set up as a seller carry. So instead of paying all those capital gains up front to the government, not having to carry it over into a 1031 that we were talking about, you can take those, take that equity and create a loan to the buyer and do that seller carry where you're setting up an interest payment. You're getting it per year. You do have to pay money on your income on that, but it's much, much reduced, and you can count on that steady stream of income. You can go on your trips. You can have a steady stream that you can count on, assuming you're a good buyer, right? From a good buyer, and then you're avoiding in a big sum that big check that. Some people don't know how to budget their money too, right? So if you do get $1 million in your hands, what do you do with it? Do you invest it? Do you send it to a financial advisor? So there's also a lot of ifs. If I get this money, what do I do with it? And so setting it up in a streamlined fashion, I think, could be a big advantage for people in multiple ways.
Yeah, 100%. I'll jump in on that as well too. The seller carry, you just got to think about this first off. When you see your money, that's when you pay taxes on it. So if at the closing table you get a big old check for $1.5 million, because that's what your campground proceeds were going to be, you're going to be paying the capital gains on that. Fortunately, it's not going to be the same as ordinary income unless you only held it for a short period of time. But I'm also not a tax advisor or CPA, so talk to your professionals on that. Point being, you're going to have a big tax bill for taking that. But think, are you going to spend that $1.5 million that year? Or do you already own your house and maybe you want to buy a really nice RV and go take some trips? So you're going to hold aside some money for that, and then you can set up, like Justin mentioned, having this vehicle that can pay you every month. You're going to be earning interest on that value while that person has that loan with you. You're going to be taking the money in smaller amounts, which means a smaller income tax liability, and you've got an asset that you can will to your heirs. So if something happens to you in the next couple of years, you can give that loan to your kids, and then they can inherit it. And if the seller, or I should say, rather, if the buyer defaults on the loan, worst case scenario, you get the property back, and then you can sell it again. And then you obviously get to keep whatever you made on the loan in that time. It's not a bad way to do business. So it's definitely a great strategy worth considering. The thing is, from my background being in the residential world, seller carry loans have a bad name sometimes, because you typically think about people who are not qualified to get a traditional bank loan, but what people often gloss over is the absolute leverage this gives both buyer and sellers to conduct these transactions privately without incorporating a big bank.
Adding to that, as well as, as the seller, you need to understand too that you actually may be getting more for your property. If you were to sell it for $2 million, then you get whatever proceeds from that. But if you were to sell a carry, now you're actually earning more because of that added interest. That you're still selling it for the $2 million price or whatever, but now you're getting also on top of that the interest. So you may get an extra, $500,000 or $1 million or however long you carry it for, based off the interest rate. So really, you're getting more out of it by doing that than just straight up selling it. Not even referring to the taxes you're saving as well.
Yeah, be the
I
bank.
Picture the big Happy Gilmore check that I got my $1 million check, and what am I going to do with it? But how many lottery winners actually end up back at the same place that they were within 3 years because they didn't take that opportunity to strategize what they were going to do with their money?
Exactly. Yeah. Not only just going in and unfortunately wasting it on things you don't need, but people come out of the woodwork. Your long lost cousin you didn't hear about, like, hey, cuz, I heard I need some help. So, and also you feel guilty. You want to help everybody out, and so your money disappears pretty quickly if you don't plan for it and know how to manage it for sure.
Well, let's be real. The reason we're here today is to say, don't give the government more than you have to. Keep that amount to an absolute bare minimum. Don't cheat your taxes, but don't give them any more than you're obligated to.
Yeah, and it's maybe make a bit of a transition with this whole time we've been talking about from the campground owner perspective. What about the investors? People that invest in these campgrounds, they'll still at one point be cashed out, right? They'll still get their capital back plus their equity gain. That's still a capital gain event for them as well. What other options do they have besides a 1031 or just reinvesting it? Is there anything else they can do?
I don't know, Don. What options do they have?
Yeah, well, good point. Yeah, honestly, this is a great question. As Adam mentioned, we're not tax advisors here, but pretty much, I've talked to some very highly skilled CPAs, and they actually, from their opinion and what they do, and I agree for reinvesting, rather than trying to do a 1031 and try to track down and find the perfect property that have that stress with the time frame. I just say take the money, find another opportunity that you have time to do, and reinvest where you can get a high depreciation to basically offset that gain. Which is, I myself did this in 2022. I sold a couple of properties I had, took the gains from that, and just reinvested it back into the Outdoor Hospitality Sun Fund with Beyonder Holdings, and got a big depreciation, which offset the gains that I had from that property as well. And I did not do a 1031 exchange and not go through a DTS or anything else that's out there. But those are some options you could do, right? You can possibly find a 1031. There are some syndications where you could do that. There's also the DTS, or I can't remember what that stands for, but
DST, Deferred Sales Trust.
DST, okay, yeah. That's another option, which is similar to like a 1031, but gives you more flexibility on what you can invest in. You can take that and put it into Bitcoin if you want or whatever, but that's an option. Otherwise, it's just really trying to track down another great investment opportunity where you can get big bonus depreciation to offset that gain, and just kind of keep that rolling forward as well. Obviously, the day you stop doing it is when you'll still have to pay that gain at some point. But if you can keep reinvesting it and keep it moving, then you can essentially kick that can down the road and hopefully maybe until you die, and then not to worry about it and pass it on the full gains to your heirs.
Yeah, the objective is put the money today to work to offset the gains you're going to pay in the future, so you can come out net neutral or ahead on what those capital gains taxes would have been. Don, you mentioned the deferred sales trust. That's a great tool as well too. It, like you said, a lot more versatile than just the 1031 exchange. Does let you get in other asset classes. We at Beyonder Holdings interviewed a gentleman named Brett Swartz who does those. He's a specialist in those. So on our YouTube channel, the Beyonder Holdings YouTube channel, anybody who's interested can catch the recording with Brett on there. I think you have to have about $1.5 million in money you're going to walk away with before it makes sense with the expenses. But definitely for a lot of the campgrounds and resorts we're looking at these days, that's an easy mark to hit.
Mm-hmm. For sure. Okay.
Very good.
And Don, can you elaborate on IRAs? I think you know a little bit more about that, but more of a retirement investment vehicle. So
yeah,
when you invest from those self-directed.
Yeah, well, that's a great point as well. Yeah, you can invest in like in campgrounds or other types of real estate through your retirement account. I'll say potentially, right? Not all are created equal, but if you have like a self-directed account, you can use that to invest in real estate. And similar to the Brett Schwartz webinar, we did a couple webinars last year as well with talking about the EQRP with Parker Purcell, and also a solo 401k or other options that are out there besides just a self-directed IRA. Each of those, of course, has different nuances to them. We're not going to get dive deep into that necessarily, but you may be hit with a couple of other taxes or fees that are in there. Even though if it's in a tax-deferred account like an IRA, you could still get hit with a UBIT tax. Or UDFI, I think that one is. That all depends on what exactly it's invested in and how the business operates. The EQRP is one of those that is out there. It's like Roth, but it avoids those taxes. But again, that is something you could use and potentially at least not be hit with those big capital gains. Might have some other taxes in there, but much reduced versus a big capital gains hit. But that is another option that is available for those that want to use that route to have access to money. You might not have a bunch of money in your savings account, but you might have a big nest egg in your IRA or 401k that you could use to keep investing and getting better returns overall than just your standard options in that plan.
Yeah. I think the biggest lesson we want to drive home here is don't do what Adam did in his younger years and try to DIY everything, because you're bound to mess something up. Trust your professionals, and don't, just because they have a CPA in their name does not mean they're qualified to give you the right advice on this. Get referrals, ask other people who are doing real estate or, investing at a high level who they use, interview multiple people. The guy who's doing your income tax return at the local, strip mall might not be the best guy for it. Not anything against those guys, guys, but they might not be the best person for it. So just ask the right questions, plan before you take action. That's all I got.
Right. And go back to the campground owners that are out there. The day you buy or start your campground, and this is taken from, I think it's the E-Myth book, where it says basically, if you start a business, have the end in mind. Like you build it in the plan to sell it someday, right? Like you said, you might not be for 50 years, but something could happen. You end up selling it in 5 years. So you need to be prepared for that and plan for it, and build your business with that end in mind. Like one day I want to sell this for the most I can get from it. I'm not just doing this just for fun. It is a business, you can't have fun with it, but it is still in the end a business. You need to treat it that way.
Amen to that.
All right.
Very good.
Well, yeah. Thanks everybody for joining us this episode. Look forward to more great conversations coming up in additional episodes. And of course, follow us on the Patreon platform, where you can get involved with the community, ask questions, and network with other people, other campground owners, operators, and learn more about the industry. Feel free to reach out to us as well if you would like to learn more.
All right. It's been fun.
Thank you for joining us on this episode of the Campground Catalyst Podcast, where we take you behind the scenes in the fun and gratifying world of outdoor hospitality. We hope you were inspired by today's show and better equipped to take the next steps in your journey. Remember, you can continue the conversation and connect with fellow enthusiasts by visiting our website and joining the Campground Catalyst community on Patreon at campgroundcatalyst.com. There, Patreon members get exclusive access to special listener perks, they get their opportunity to engage with the host, and they get their questions answered on one of our future upcoming shows. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted partner in fueling your success in outdoor hospitality. Until next time, keep both your campfires and your passions burning.